You know, sometimes what looks obvious can be quite easily misunderstood. Do you think there's even a cup here? And perhaps that is the best way to describe today's stock. What's going on, everyone? So today's stock that I want to talk about is TFS Financial Corp. They're a small regional bank that's based in Cleveland, Ohio. Most of their loans are in Ohio, and then maybe like 20-25% of their loans are in Florida. If you try to look up the stock in any sort of stock dashboard, you're going to get all kinds of wrong information. So the PE is definitely not 78. The market cap is not 5 billion, and the price to book is definitely not 3. Perhaps what's right though is the dividend yield is at 6.3%. So I think this stock potentially could have 20-25% returns maybe in the next 2 years. And the key is it probably does not have much downside at all. All right, so why is this happening, and why do I like this company so much? Prior to 2007, the bank used to be a mutual savings bank, and so it was owned by their depositors. And then it went public in 2007. It went through a mutual to stock conversion where the parent holding company owned 70% of the subsidiary. And then in the subsidiary, 30% of the shares went public. So because the holding company never contributed any new capital, they don't participate in the earnings of the company or the dividend. So every year when the dividends are announced, they waive their rights to it. And I think because of this misunderstanding, and partly for other reasons that we'll get into, share prices have traded on average at about 50% of book value. And so they've just been buying back their shares at a discount every year. In fact, from 2007 to now, they've reduced their public float by almost 50%. The book value per share has increased from $19 all the way to about $31.50. So now the holding company owns 81% and the public owns 19%. And that's just purely from the reduction of the public floating shares. Now, due to the pandemic, they've temporarily halted their share buybacks. But what's happening is now they're holding record number of cash that they've ever had before. So I think they're probably going to resume it come next year, or maybe they'll dish out like a special dividend. There is also a small chance of a lottery ticket scenario where the holding company, the 81%, that might actually go public in a second stage conversion. And when that happens, public bank shares usually trade, pretty close to book value. So if you have that second IPO, it might actually lift the value of all the other shares. There is merit as to why TFS trades at a discount compared to other banks. And I'll show you some of these comparative charts. So historically, TFS has not returned a very high return on equity. You can see it started off really well, and then the financial crisis hit. And since then, the return on equity has really started climbing back up again. It's a very conservatively run bank. They have lots of capital, probably some of the highest that I've seen. They're not overly leveraged at all. And they're just a plain vanilla lender. They have all their products are just mortgages to residential owners. and they have just a tiny bit of construction loan, but they don't have any commercial operations at all. They're not like other giant banks that have trading revenues or massive amounts of service fees. They're just, they basically make money in two ways, kind of like the most basic structure of a bank. They offer loans and collect interest on those loans at a higher rate compared to the interest that they pay out to their depositors. And so they collect the net interest margin on that spread. And the second way that they make money is they collect service fees on servicing these mortgage. They're mortgage servicers. And so because of, they don't really have many levers to pull, their return on equity suffers compared to other banks. And they're safer, but at the same time, their returns are a little bit lower. And, you really want your banks to make at least an 8 to 10% return on equity every year. And you can see TFS, is barely squeaking out with almost 5%. And here's the net interest margin for TFS, and it's, one of the lowest compared to all the other banks that I'm comparing it to. And these other banks, they're not the best comparables, but it's really hard to find a comparable to TFS because most banks have commercial operations, or they just have other ways of generating income besides just lending. And so I tried to just find banks where the capital was about the same amount as TFS. So Northwest Bankshares has similar amounts of capital, or similar amounts of assets at $13.8 billion, and Washington Federal is another good comp. Here's their efficiency ratio. The industry calls it the efficiency ratio. I like to call it the inefficiency ratio. And this ratio is just the non-interest expense divided by the sum of net interest income plus non-interest income. It's really a measure of the overhead of a bank. And you want this ratio to be as low as possible, preferably below 60. Even better if it's under 55. But other banks have ways of generating non-interest income, and so that's how they manage to push their efficiency ratios lower. TFS doesn't have a way to generate other non-interest income, so they're kind of stuck with a higher efficiency ratio of 65. And so I just think that this is kind of a great bank. You have a very safe bank. It's yielding 6.3% dividends every year. Meanwhile, it's just buying back, all of its shares. And I hope they resume their buyback after the pandemic is over. They're starting to incorporate adjustable rate mortgages into their loan books. And so as interest rates rise in the next coming few years, hopefully their net interest margin will then expand, and they'll be able to increase that return on equity a little bit more. And then the CEO has said that he's not considering the second stage conversion anytime soon. But he's 65 years old and he might actually retire soon. So you still have this lottery scenario where it might happen, who knows? And I think for all of these reasons, you have limited downside. It might just be a good opportunity to, pick up a pretty good bank. So let me know what you think. And if you enjoy this video, don't forget to like and subscribe, and I'll see you in the next video. Thanks.